You ever wonder what it would be like if you could peek inside the mind of someone who's built a stock portfolio that doesn't just make money, it practically writes its own success story? I'm Jim Simons, and today I'm going to pull back the curtain on how I approach investing and how you can start thinking about your own portfolio in a way that's smart, systematic, and yes, almost unstoppable. When it comes to investing, the very first lesson I learned, and the one I would insist every investor understand, is that gut feelings and instinct are overrated. The market has a way of humbling anyone who thinks they can predict it based on intuition alone. You might feel confident about a stock because of a news headline, a tip from a friend, or even your own sense of this feels right. But in reality, the market doesn't respond to feelings, it responds to data. It responds to patterns, probabilities, and measurable trends. That's why I've always approached investing like a mathematician approaches a problem, systematically, methodically, and with no room for emotion to cloud judgment. The first step in putting this into practice is to shift your mindset from "I hope this works" to "what do the numbers tell me?" Every stock, every sector, every market trend is a piece of information. And when you stop seeing it as a gamble and start seeing it as data, you gain a completely different perspective. You start to ask the right questions. What are the historical patterns? How often has this type of situation repeated itself? What are the probabilities of different outcomes? And more importantly, what does the data say about risk versus reward? That is where the real advantage lies. You're not guessing, you're analyzing. Now, this isn't to say that intuition has no place at all. Human judgment can sometimes identify opportunities or risks that raw data might not fully capture. But the danger comes when you let intuition dominate the decision-making process. When emotions get involved, you start chasing trends, reacting impulsively to headlines, or holding on to losing positions out of stubbornness or fear. I've seen it countless times. People convince themselves they have a hunch only to watch their portfolio take a hit. The market doesn't care about your hunches. It cares about probabilities, and probabilities are built on data, not feelings. One of the most powerful tools in this approach is testing. Before committing real capital, I would test strategies rigorously using historical data, simulations, and pattern analysis. This allows you to separate the ideas that work from those that are just appealing in theory. It also trains you to think in terms of probabilities instead of certainties. You're not trying to find a stock that will definitely go up. You're looking for scenarios where the odds are in your favor and where losses are limited if things don't go as planned. That mindset alone transforms the way you build a portfolio. Another critical aspect is recognizing patterns. Markets move in cycles, and certain behaviors repeat themselves over time. By observing these patterns carefully and systematically, you can make decisions that are far more informed than simply following the crowd. The key is consistency. You measure, you analyze, and you let the data guide you. You don't let a sudden surge in a stock or a sensational headline dictate your next move. Your decisions are rooted in evidence, and that's what separates long-term winners from short-term gamblers. Finally, focusing on data helps remove emotion from investing, which is crucial for building a portfolio that can endure over time. Greed, fear, and impatience are the biggest enemies of any investor. When you rely on data and probabilities, you create a buffer against those emotional impulses. You can make rational decisions even in volatile markets because you know that your strategy isn't based on luck, it's based on logic, analysis, and repeatable results. In the end, the lesson is simple but powerful. If you want a portfolio that consistently performs, you have to respect the numbers. Don't guess. Don't follow feelings. Don't let fear or excitement drive your decisions. Treat investing like solving a puzzle and let the data show you the way. That's how you go from hoping for wins to creating a strategy that systematically stacks the odds in your favor. And that mindset is the foundation for everything that comes next. Thinking like a mathematician is more than just a metaphor when it comes to investing. For me, it was the foundation of everything I did. You see, the stock market is a complex system with countless variables interacting in ways that aren't always obvious at first glance. It's easy to get overwhelmed or think that success depends on luck, timing, or having a special touch. But the truth is, the market follows patterns, trends, and probability, and mathematics is the tool that allows you to understand them. When you start to approach investing this way, it changes everything. The first step in thinking like a mathematician is adopting a mindset of curiosity and rigor. You don't take things at face value. You ask questions, you test assumptions, and you constantly look for evidence to support your decision. For example, when evaluating a stock, you don't just look at the headlines or recent performance, you break it down. You analyze historical data, financial statements, market cycles, and even macroeconomic factors. Every piece of information becomes a variable in a larger equation, and your goal is to see how all the pieces fit together. One of the most important lessons I learned from math is the value of precision. In math, a small error in a calculation can completely change the outcome. Investing is the same way. Small mistakes buying at the wrong price, misjudging risk, or misreading a trend can multiply over time and hurt your results. That's why I always emphasize careful, precise analysis. It's not glamorous, and it's not exciting, but it's far more reliable than chasing tips or following your gut. Precision in analysis translates into clarity in decision-making, and clarity is everything. When you're building a portfolio that can withstand market ups and downs, another critical aspect is testing and iteration. Mathematicians don't just solve a problem once and assume they're done. They test their solutions, check their work, and refine their methods. In investing, this means you don't just pick a strategy and hope it works. You simulate it, analyze past data, run scenarios, and adjust your approach based on results. You learn what works and what doesn't before risking real money. This scientific approach reduces uncertainty and builds confidence, because every decision is backed by evidence, not luck or emotion. Thinking like a mathematician also means thinking in probabilities, not certainties. Nothing in the market is guaranteed. There will always be volatility, surprises, and risk. But if you understand probabilities, you can make decisions that put the odds in your favor. You can weigh the potential gains against the risks and take calculated steps that improve your chances of success over time. This mindset allows you to approach investing rationally rather than emotionally. You accept that losses happen, but you structure your portfolio in a way that keeps your overall strategy intact. One of the most powerful benefits of this approach is removing emotion from the equation. Greed, fear, impatience, and overconfidence are all natural human responses to market movements, but they often lead to mistakes. Math doesn't get emotional. Patterns and probabilities don't care if you're nervous or excited. By thinking like a mathematician, you rely on logic and evidence rather than reaction. You make decisions based on what's likely to happen, not what you hope will happen. This mental shift alone can transform your results over the long term. Finally, think like a mathematician encourages discipline and consistency. Markets can be unpredictable in the short term, but systematic, rational strategies tend to succeed over time. When you rely on data, analysis, and probabilities, you develop a process that's repeatable and sustainable. You're no longer chasing trends or reacting to every market headline. Instead, you have a framework that guides your decisions, keeps you disciplined, and maximizes your long-term success. In the end, thinking like a mathematician isn't about memorizing formulas or performing complicated calculations in your head. It's about adopting a mindset of logic, rigor, precision, and patience. It's about analyzing data, testing strategies, and making decisions based on probabilities instead of emotion. When you do that, investing stops being a gamble and starts becoming a structured, methodical process where the odds are stacked in your favor. And that mindset is what allows real, lasting success to grow over time. When I think about a portfolio, I don't see it as a collection of individual stocks. I see it as a web, a carefully structured system where each piece contributes to the overall strength. That perspective has made all the difference in how I build and manage investments. Most people focus on the idea of finding the next big winner or the single stock that will double overnight. That's exciting, sure, but it's also risky. A portfolio that depends on one or two stars is fragile. It can crumble if the market shifts unexpectedly. What I've learned over decades is that lasting success comes from balanced diversification, constructing your investments so that they reinforce each other rather than relying on luck. Imagine for a moment a spider web. Each strand has a purpose. Some strands may snap under pressure, but the web as a whole remains intact because it's built intelligently and connected in a way that distributes tension. That's exactly how I think about a portfolio. Every stock, bond or investment choice is like a strand. Some will perform better than others at any given time, some will falter, but if the overall structure is sound, the portfolio can endure stress and volatility without collapsing. This mindset completely changes the way you approach risk because you're no longer looking for individual perfection. You're building resilience. The key to constructing a strong portfolio is understanding correlation. Different investments respond differently to the same market conditions. Some move together, others move in opposite directions. By carefully analyzing how your holdings interact, you can reduce risk and smooth out volatility. That doesn't mean eliminating risk entirely. Risk is part of investing, but it does mean avoiding unnecessary exposure that could derail your long-term plan. You're not just picking stocks randomly. You're selecting pieces that fit together in a way that strengthens the whole. Diversification isn't just a buzzword, it's a practical tool for survival. A diversified portfolio is like having multiple engines in a plane. If one engine fails, the others keep you moving. I've always approached diversification systematically, looking at different sectors, industries, and asset classes, and sometimes even strategies within a single asset class. The goal is to create a network of investments where individual failures are absorbed by the strength of the collective. That's what allows a portfolio to weather market storms and continue growing steadily over time. Another important aspect of this approach is thinking in terms of probabilities and outcomes rather than certainties. Some investments will perform extraordinarily well, some will fail, and many will land somewhere in the middle. That's fine. The portfolio is designed to capture the gains from the winners while limiting the damage from the losers. It's not about being right all the time. It's about ensuring that the system as a whole continues to generate positive results. You stop worrying about every small loss and focus on the larger picture, which is exactly what builds lasting wealth. Discipline plays a huge role here too. A portfolio built like a web requires consistent attention, periodic adjustments, and careful monitoring of how each piece is performing. You don't abandon it at the first sign of trouble, but you also don't tinker with it impulsively. You make changes based on evidence, patterns, and long-term strategy rather than short-term panic. That discipline, combined with diversification and a clear understanding of correlations, is what separates investors who survive and thrive from those who get caught chasing trends and reacting emotionally. Ultimately, thinking of your portfolio as a web shifts your mindset from chasing individual wins to building a resilient, adaptable system. You're no longer placing all your hopes on one star performer. You're designing a structure that can withstand the ups and downs of the market while continuing to grow steadily. It's about balance, intelligence, and foresight. And when you embrace that approach, investing becomes less about luck and more about control. You create a portfolio that isn't fragile or dependent on chance, but one that's engineered to endure, adapt, and succeed over time. Risk management is something every investor talks about, but very few truly understand how to implement it in a way that actually protects a portfolio. I've spent decades studying the market, running numbers, and observing what works and what doesn't, and I can tell you this: the difference between consistent winners and people who lose everything is how they handle risk. It's not about avoiding risk entirely. There's no way to do that in investing, but it's about controlling it, understanding it, and making sure your portfolio is structured to survive when markets don't behave the way you expect. When most people think about risk, they imagine sudden drops in stock prices or market crashes, and that's not wrong. But risk is also about exposure and probability. It's about knowing how much your portfolio can withstand before it starts to unravel. It's about asking yourself, if this investment goes against me, how much will it affect the whole system? And even more importantly, what can I do to limit that effect? That mindset shifts your thinking from hoping for gains to planning for stability, and stability is what allows long-term success. One of the first lessons I learned is that you cannot control the market, but you can control your position sizes, your allocation, and your strategy. Every investment should be considered in terms of its potential gain and potential loss. You should know in advance how much you are willing to risk on any single trade or position. That doesn't mean you avoid opportunity. It means you are smart and disciplined about exposure. By limiting risk on individual positions, you prevent a single mistake from snowballing into disaster. Another critical aspect of risk management is diversification, and not just in a casual sense. I mean, true, deliberate diversification across sectors, asset classes, and strategies. The idea is to create a portfolio where the performance of one investment doesn't dominate the overall outcome. Some investments will fail, some will underperform, and some will exceed expectations. That's normal. But if your portfolio is structured intelligently, the winners will outweigh the losers over time, and the losses will never threaten the entire system. That's what separates long-term investors from short-term gamblers. Monitoring is equally important. Risk management isn't a set-it-and-forget-it exercise. The market is constantly changing, and the relationships between assets evolve over time. A position that was low risk 6 months ago could become much riskier today. That's why it's essential to track performance, correlations, and exposure regularly. By doing so, you can make adjustments before problems become catastrophic. Staying proactive rather than reactive is one of the most underrated aspects of managing risk. Another principle I follow is cutting losses quickly. This is where emotion often sabotages investors. People hold on to losing positions because they don't want to admit a mistake or they hope it will bounce back. But the truth is, losses are part of the game. Accept them early, analyze why they happened, and move on. Protecting your capital is more important than trying to salvage a position that is already working against you. That discipline allows you to stay in the game for the long run, which is where the real gains happen. Finally, risk management is not just about preventing loss, it's about creating freedom. When you know your portfolio is protected, you can make decisions with confidence. You can take calculated risks that have high probabilities of success without fearing that a single misstep will destroy everything. That sense of control allows you to focus on strategy, analysis, and execution rather than worry and reaction. In the end, risk management is the backbone of a portfolio that can endure and succeed over time. It's not glamorous or exciting, but it's absolutely essential. By controlling exposure, diversifying intelligently, monitoring positions, and maintaining discipline, you create a system that can survive volatility and capitalize on opportunity. That's how real investors think. And that mindset is what separates those who consistently win from those who are always chasing luck in the market. Discipline is, without question, one of the most important traits an investor can cultivate, yet it's often the hardest to maintain. I've seen countless people with brilliant ideas and promising strategies fail, not because they didn't know what to do, but because they couldn't stick to it. The market is loud, unpredictable, and constantly throwing challenges your way, and it's easy to let emotion take the wheel. Fear, greed, impatience, or even overconfidence can push you to make decisions that undermine everything you've worked to build. That's why discipline isn't just helpful, it's essential. When I talk about discipline, I'm not just talking about following a set of rules blindly. I'm talking about creating a framework for decision-making and then trusting that framework even when the market tries to convince you otherwise. It's about having a plan for every trade, understanding why you're entering a position, and knowing under what conditions you'll exit. Once those rules are in place, discipline is the ability to follow them consistently, even when it's uncomfortable or unpopular. Most investors fail, not because their strategies are bad, but because they abandon them too early or let impulses dictate their actions. Discipline also means resisting the noise. Markets are full of opinions, predictions, and sensational headlines, all screaming for attention. It's tempting to chase trends, jump on hot tips, or react to sudden price movements. But a disciplined investor learns to filter out that noise. You focus on the data, the probabilities, and the strategy you've built. You don't get pulled into panic selling or euphoric buying because someone on TV says it's the next big thing. Discipline keeps you grounded and prevents short-term distractions from derailing your long-term plan. Another key element of discipline is patience. Many people want results immediately. They see a strategy, they execute it, and if it doesn't pay off in days or weeks, they abandon it. But investing is not about instant gratification. Real, lasting results come from staying consistent over months, years, and even decades. Discipline means having the patience to let your strategy play out, understanding that volatility is natural, and accepting that success often requires waiting for the right conditions. Without patience, even the best ideas can fail because they're abandoned too soon. Discipline also manifests in managing losses effectively. Every investor experiences losses. There's no way to avoid it completely. But disciplined investors handle losses in a controlled way. They don't let a single loss escalate into panic or revenge trading. They analyze why it happened, adjust if necessary, and move forward without letting emotion cloud their judgment. That ability to stay calm and stick to the plan in the face of setbacks is what separates consistent winners from those who are always reacting and losing control. Consistency is a natural byproduct of discipline. When you have rules, stick to them and follow your strategy with patience. The results compound over time. You're not looking for dramatic wins. You're building a portfolio that steadily grows, surviving the ups and downs along the way. Discipline is what allows you to execute strategies repeatedly, learn from experience, and improve without falling victim to emotional impulses. Finally, discipline gives you confidence. When you know your decisions are grounded in logic, data, and a tested strategy, you can act decisively rather than hesitating or second-guessing yourself. You trust your framework because it's been designed to handle uncertainty and volatility. That confidence allows you to take calculated risks, stay calm under pressure, and ultimately achieve results that are far more consistent than relying on instinct or luck alone. In the end, discipline is the backbone of successful investing. It's not about following rules rigidly for the sake of it. It's about building a system, trusting it, and executing consistently in the face of market chaos. Fear and greed will always exist, but a disciplined investor knows how to rise above them, focus on long-term objectives, and make decisions that align with strategy rather than impulse. That mindset, above all, is what allows portfolios to grow steadily and survive, even when the market gets unpredictable. One of the most important lessons I've learned over the years is that small losses are not just inevitable. They're essential. Many investors fear losses to the point that they hesitate to make decisions or hold on to losing positions far too long, hoping they'll recover. That kind of thinking is dangerous because it allows emotion to dictate your actions. But the reality is, accepting that some trades will fail and learning how to manage those losses is what separates consistent winners from everyone else. Small, controlled losses are not failures. They're part of the system that allows your portfolio to thrive over time. The key is to understand that investing is a probabilistic game, not a deterministic one. No strategy will be right 100% of the time, and no stock will always go up. What matters is how you position yourself to benefit from the winners while limiting the impact of the losers. That means defining in advance how much you are willing to risk on a trade and sticking to that limit no matter what. It's not about avoiding losses. It's about managing them so they don't derail your entire portfolio. By keeping losses small, you preserve capital, maintain flexibility, and give yourself the ability to capitalize on better opportunities when they come. Another aspect of managing losses is cutting them quickly. One of the biggest mistakes investors make is holding on to a losing position out of pride, hope, or stubbornness. They think it's going to turn around eventually, but the market doesn't care about hope. A disciplined investor recognizes when a position isn't working according to the plan and exits quickly. By doing so, you prevent a single mistake from escalating into a catastrophic loss. It's like trimming a branch before it damages the tree. Small, deliberate actions protect the whole system. Learning from losses is just as important as managing them. Every small loss provides data. Why did this trade fail? Was the analysis flawed? Did external factors intervene? By studying mistakes carefully, you can refine your strategy, improve your decision-making process, and avoid repeating the same errors. In other words, losses are not just setbacks. They're lessons that, when approached systematically, make your future trades stronger. That mindset transforms losses from something to fear into something to learn from, and that shift is crucial for long-term success. Patience also plays a critical role here. Many investors panic when they see losses and make impulsive decisions that compound the problem. A disciplined approach requires stepping back, analyzing the situation rationally, and making measured adjustments. You accept that losses will happen, but you ensure that they are controlled, understood, and factored into your broader strategy. By treating losses as part of the natural ebb and flow of investing, you maintain the clarity and focus needed to execute your plan consistently. Another subtle but powerful aspect is mindset. If you fear every loss as a catastrophe, you become paralyzed and stop taking the actions necessary to grow your portfolio. By accepting small losses as normal and manageable, you free yourself to make calculated, rational decisions. You're no longer reacting emotionally to market movements. You're acting strategically, using every piece of information to your advantage. This approach builds confidence because you know that a small setback is just one part of a larger, well-structured plan. In the long run, the goal isn't to avoid losses, it's to ensure that the wins outweigh the losses and that your portfolio continues to grow steadily. Small, controlled losses are the price of playing the game intelligently. They preserve capital, provide valuable lessons, and keep your strategy on track. By accepting losses as part of the process, learning from them, and managing them rigorously, you create a system that is resilient, adaptive, and capable of delivering consistent results over time, ultimately embracing small losses is a mindset shift. It's about understanding probabilities, controlling risk, and staying disciplined. It's about removing fear and ego from the equation and focusing on the long-term structure of your portfolio rather than short-term fluctuation. That perspective is what allows you to stay in the game, capitalize on opportunity, and build lasting wealth steadily, no matter how volatile the market gets. One of the most important insights I've gained over the years is that investing isn't about luck or guessing. It's about building a systematic approach. A systematic approach means creating rules, processes, and strategies that guide your decisions instead of relying on intuition or hope. Most investors think the key to success is finding the perfect stock or predicting the next big trend. But the reality is that those things are unpredictable. What you can control is your process, your approach, and the way you consistently apply it over time. That's where real advantage lies. And that's why I've always emphasized create systems that anticipate patterns rather than reacting impulsively. The beauty of a systematic approach is that it removes much of the emotion from investing. Markets are inherently emotional. They swing between fear and greed, euphoria and panic. When investors let those emotions drive their decisions, they tend to overreact, chase trends, or hold on to losing positions far too long. A well-designed system doesn't care about headlines or hype. It follows a set of predefined rules that have been tested and refined, which allows you to make rational decisions even when the market is chaotic. That consistency is one of the most powerful advantages an investor can have. Building a system starts with observation and analysis. You study historical data, identify patterns, and understand how different factors interact over time. This doesn't mean trying to predict the future perfectly. It's about recognizing probabilities and trends that are more likely to occur based on what has happened before. Every trade, every position, and every adjustment becomes part of a larger framework that guides your decision-making. You're not guessing. You're executing a plan that is informed by logic, mathematics, and careful observation. Another key aspect is testing. A system only works if it's been tested and refined. I've always emphasized running simulations, analyzing past performance, and making adjustments before committing real capital. This allows you to see what works and what doesn't without risking significant losses. It also teaches discipline because you're following a process that's been validated by data rather than acting on impulse. Testing provides confidence and reduces uncertainty, which are critical when the market inevitably throws surprises your way. A systematic approach also encourages consistency in execution. Many investors have good ideas, but they're inconsistent in applying them. One day they follow a strategy perfectly, and the next day they let emotions take over. That inconsistency undermines results. When you have a system in place, you're less likely to deviate from your plan, which allows compounding and long-term growth to work in your favor. You're creating a structure where decisions are repeatable and measurable rather than chaotic and reactive. Perhaps most importantly, building a system allows you to manage risk effectively because every position is part of a larger framework. You can see how each decision affects the portfolio as a whole. You can plan for losses, limit exposure, and ensure that no single mistake can derail your overall strategy. That kind of risk control is only possible when you have a process that is systematic, consistent, and based on probabilities rather than guesswork. Finally, a systematic approach gives you clarity and confidence. When the market gets volatile, when trends shift unexpectedly, or when everyone around you is panicking, You have a framework to guide your decisions. You're not reacting emotionally, you're acting logically. You understand the probabilities, you follow the rules, and you trust the process. That clarity allows you to focus on long-term outcomes rather than short-term noise, which is exactly what builds lasting wealth. In the end, investing without a system is like sailing without a compass. You might catch favorable winds now and then, but over time, you're at the mercy of forces you don't control. A systematic approach, on the other hand, gives you direction, structure, and resilience. It allows you to anticipate patterns, manage risk, and make disciplined decisions that compound over time. By thinking in systems instead of guesses, you turn investing from a gamble into a calculated process, and that mindset is what separates consistent winners from everyone else. Patience is one of those qualities that sounds simple in theory but is incredibly difficult to practice in investing. When you look at the market, it's easy to get caught up in short-term fluctuations, daily headlines, and the pressure to see immediate results. Most investors want their strategies to pay off instantly. They get impatient when a trade doesn't move as expected or when a stock doesn't spike the way they hoped. But here's the reality. Investing is a long game, and patience is one of the most powerful tools you can develop to succeed over time. When I talk about patience, I'm not just talking about waiting. I'm talking about disciplined waiting, understanding when to act, when to hold, and when to let your strategies work themselves out without interference. Markets move in cycles, and trends often take time to play out. Trying to force quick results usually leads to mistakes, impulsive decisions, and missed opportunities. Patience allows you to stick with your plan, trust the data, and let the probabilities unfold over time. That's how long-term success is built. One of the biggest challenges with patience is resisting the urge to react emotionally to market swings. Fear and greed are incredibly strong forces. When prices drop suddenly, fear can push you to sell at the worst possible time. When prices rise quickly, greed can make you overcommit or chase a trend. Patience acts as a buffer against these impulses. It gives you the discipline to step back, analyze the situation rationally, and make decisions based on logic rather than emotion. That's the difference between short-term noise and long-term strategy. Patience also allows you to take full advantage of compounding. The true power of investing comes from letting small gains accumulate over time. When you act impulsively or constantly switch strategies because you're frustrated by short-term results, you interrupt that compounding process. Even small, steady gains, when allowed to grow patiently over months and years, can produce results far beyond what most people imagine. Patience ensures that your portfolio has time to grow in a controlled, consistent way without unnecessary interruption. Another important aspect of patience is understanding that losses are temporary and part of the process. No investor avoids losses entirely. Some trades won't work out, and some strategies will underperform for a period. Impatience often causes people to abandon these strategies prematurely, missing the eventual recovery or upside. By practicing patience, you give yourself the opportunity to learn from setbacks, adjust thoughtfully, and allow your investments to reach their potential over time. That's how disciplined investors turn challenges into advantages. Patience also reinforces consistency. When you are patient, you're more likely to follow your systems and strategies consistently, even during volatile periods. Consistency is crucial because it allows the probabilities and patterns you rely on to manifest. It prevents you from chasing trends, reacting to every headline, or abandoning a tested strategy out of frustration. Patience and consistency work hand in hand, creating a foundation for long-term growth and minimizing unnecessary risks. Finally, patience gives you clarity and confidence. When you know that short-term fluctuations are part of the natural ebb and flow of the market, you don't panic when things don't move immediately in your favor. You can stick to your plan, trust your analysis, and act decisively when the right opportunities arise. That calm, measured approach is what separates investors who succeed over decades from those who burn out chasing quick wins. In the end, patience isn't just a virtue, it's a strategy. It allows you to remain disciplined, stick to your process, manage risk effectively, and take full advantage of compounding. Markets will always have ups and downs, surprises, and volatility, but when you cultivate patience, you give yourself the time and space to make rational decisions and build wealth steadily. That mindset is what transforms investing from a series of reactions into a long-term, controlled, and highly effective process. One of the most common mistakes I see investors make is chasing flashy trends and looking for dramatic wins. The media makes it seem like investing is about finding the next hot stock, buying at exactly the right moment, and riding it to overnight riches. The truth is far more subtle and far more powerful. Real, lasting success in investing isn't about flashy moves. It's about consistency. The steady, disciplined application of a strategy over time produces far greater results than trying to chase every new opportunity that appears on the horizon. Consistency is the backbone of a winning portfolio because it allows your strategy to compound over time. When you follow the same principles, maintain discipline, and adhere to a proven approach, the gains from your successful investments accumulate while the losses are managed and minimized. Think of it like building a wall brick by brick. A single brick may not seem like much, but when you lay them consistently and carefully over time, the wall becomes strong and enduring. In investing, consistency works the same way. Each disciplined decision contributes to long-term growth, and over years and decades, those decisions compound into significant results. One of the reasons consistency matters so much is that the market is inherently unpredictable. There will always be ups and downs, unexpected events and fluctuations that seem impossible to anticipate. Trying to react to every headline, trend, or sudden spike is a recipe for inconsistency and ultimately underperformance. Instead, disciplined investors focus on their process, stick to their rules, and execute strategies that have been tested over time. That steadiness allows them to capture gains while opportunities arise, while remaining protected when markets turn volatile. Consistency is not exciting, but it's far more effective than chasing luck. Another critical component of consistency is systematic evaluation. Even as you stick to your strategy, it's important to monitor your portfolio, track performance, and make adjustments when data suggests they are necessary. The difference is that these adjustments are not emotional reactions. They are calculated, evidence-based decisions. You're consistent in your approach, but flexible enough to refine it when needed. That balance between consistency and informed adaptability is what allows portfolios to grow steadily without being derailed by market surprises. Consistency also builds confidence. When you follow a disciplined process and see that it produces reliable results over time, you stop second-guessing yourself. You're no longer swayed by every sensational story, market rumor, or sudden trend. Confidence comes from knowing that your strategy is grounded in data, logic, and repeat success, and that allows you to make rational decisions even during volatile periods. When the market tests you, consistency provides a stable foundation that lets you stay focused on the long-term outcome. It's also important to remember that consistency minimizes mistakes. One of the biggest risks in investing is impulsive decisions driven by emotion. Selling too early, buying too late, or chasing hot trends without analysis. By sticking to a systematic approach, you reduce the influence of emotion, limit errors, and ensure that your actions are guided by a thoughtful, repeatable process. Over time, this disciplined approach produces results that are far more predictable and sustainable than relying on luck or intuition. Finally, consistent investing aligns with the natural compounding of wealth. Small, steady gains repeated over time, grow exponentially. It may not feel dramatic day to day, but over months, years, and decades, the effect is profound. Consistency turns ordinary decisions into extraordinary results, and it ensures that the portfolio you're building today continues to grow steadily, even when others are chasing fads or reacting impulsively. In the end, winning portfolios are not built on flash or hype. They are built on consistency. Discipline, process, patience, and careful execution allow you to make rational decisions, limit mistakes, and let compounding work in your favor. By focusing on steady, methodical investing rather than chasing every trend, you create a system that produces reliable results over the long term and gives you control over your financial future. Thinking differently is one of the most powerful advantages you can have as an investor. Most people approach the market in a conventional way. They follow trends, listen to the latest headlines, and make decisions based on what everyone else seems to be doing. That's a crowded approach, and it rarely leads to exceptional results. The real edge comes from seeing opportunities that others overlook, analyzing data in ways that others ignore, and approaching investing with a mindset that challenges conventional wisdom. Thinking differently doesn't mean taking unnecessary risks or acting recklessly. It means applying strategy, logic, and analysis in ways that put you ahead of the crowd. One of the first steps to thinking differently is questioning assumptions. Just because a stock is popular or a strategy is widely recommended doesn't mean it's the best choice for your portfolio. Conventional wisdom can be comforting, but it can also be misleading. I've always tried to look beyond surface-level explanations and dig deeper into the underlying patterns, probabilities, and relationships. That kind of analysis often reveals opportunities that are invisible to the average investor and allows you to make decisions that are both smarter and more strategic. Thinking differently also requires independence. You need the courage to stick to your analysis and your strategy, even when everyone around you is doing something else. Markets are emotional, and it's easy to be swayed by fear or excitement. When you develop the confidence to rely on your own framework and your own data, you remove the influence of herd behavior. That independence doesn't mean ignoring reality. It means evaluating it carefully and acting based on logic rather than conformity. Most investors react to what everyone else is doing, and that's why they often buy high and sell low. Thinking differently allows you to break that cycle. Another key aspect is being analytical in ways others are not. It's not enough to just collect data. You have to understand it, interpret it, and apply it strategically. Many investors see numbers but fail to see patterns. Many follow trends but don't understand the probabilities behind them. When you think differently, use math, statistics, and analysis to uncover insights that aren't obvious. You're not guessing. You're building a portfolio based on evidence, probabilities, and tested strategies. That approach consistently gives you an edge over the average market participant. Differently also means being patient and disciplined. It's easy to spot opportunities, but it's harder to wait for the right condition. Execute your strategy carefully and manage risk along the way. Many investors abandon their approach when it gets uncomfortable or when short-term results don't match their expectations. Thinking differently requires the ability to stay the course, trust the process, and let your system work over time. Patience combined with strategic thinking creates a powerful combination that consistently outperforms emotional reactive investing. Innovation plays a role as well. Thinking differently often involves looking for new ways to analyze the market, new methods to evaluate risk, or new patterns that others haven't noticed. It's about being curious, testing hypotheses, and not being satisfied with conventional answers. Investors who innovate strategically gain insights that the majority miss, which gives them an advantage in positioning their portfolios for long-term growth. Ultimately, thinking differently is what allows you to go beyond the average results. It's not about taking unnecessary risks or acting impulsively. It's about questioning assumptions, relying on your own analysis, understand patterns and probabilities, staying disciplined, and being willing to innovate. That mindset allows you to see opportunities where others see noise, make decisions based on logic rather than emotion, and structure a portfolio that consistently performs over time. In the end, thinking differently is the cornerstone of exceptional investing. When you challenge conventional wisdom, rely on analysis, trust your framework, and approach the market strategically, you create a real advantage that few others possess. That mindset, combined with discipline, patience, and a systematic approach, is what separates consistently successful investors from the crowd and allows you to build wealth in a way that is deliberate, calculated, and sustainable.